Hey, good morning, options traders. Well, I hope everybody had a fabulous holiday yesterday for Thanksgiving, and it's now time to get back to options trading. And I wanted to talk about a little bit of a quick switch, how you can change from a double calendar to a double diagonal. And part of the point of this video is to show you that a lot of options strategies just depend on how you look at things. They can sound very complicated, but sometimes it's just a matter of switching things around. So remember, there's only two types of options, calls and puts. You have two positions, long and short. So there are only so many ways that you can combine these four different pieces into different strategies. So rather than seeing these as a lot of complicated strategies, learn how to make them simple. And this is a real good example. Watch how quick it is to switch from a double calendar to a double diagonal. So for a calendar spread, let's do a quick review. Remember, you are going to, let's say, buy a longer dated call and sell a shorter dated call. We could also use puts as well. But whatever date you buy, the one that you sell just has to have less time until expiration. They do have to have the same strike. That's what makes them a calendar spread. Now, if you're using a double calendar spread, it just uses two calendar spreads with different strikes. So you might use the 100 put calendar and the 105 call calendar. That's two different calendar spreads with two different strikes, and then you will have more of the classic looking double calendar strategy. All right, let's take a look at a diagonal spread. A diagonal spread is similar. You're going to buy a longer dated call. You could also use puts. You will sell a shorter dated call against it. But now they have to have different strikes. So if you use a double diagonal, that uses two diagonal spreads with different strikes. So it's this whole idea of having different strikes that really makes them a diagonal spread versus a calendar spread. So what's one way that we could look at a calendar spread? Well, we just talked about this recently. Let's look at a strangle. Here's a long strangle, the 100-105, and typically we would construct this by putting the $100 put on the left. That's the one that we're buying. And we will buy the 105 call. Let's put it on the right. You're long the call and the put. Typically, the lower strike put is on the left, the higher strike call is on the right. Both of these options are out of the money. So the stock might be somewhere in between, let's say at 102.50. Now for this risk graph in blue, let's say it has whatever, 2 months until expiration, and maybe we sell a 30-day option against it. But we're going to use the same strikes. So if I sell a strangle, might look like this. This might be the short $100 put on the left and the short 105 call on the right. So it's exactly the same strangle that we bought. We're just selling it and we're making it a shorter dated expiration. So notice how I've done this. This is just a strangle swap, we might call it. And notice the pairings here. This is one way to look at it. If we look at the long 100 put combined with the short 100 put, what is that? Well, that is a calendar spread. Over on the right, we could look at the long 105 call paired with the short 105 call, and that is also a long calendar spread. So we have two calendar spreads, different strikes. We have a double calendar. So if we put these two strategies on, we bought the 100-105 strangle and we sold a shorter dated 100-105 strangle, this is what we would get. Now, when you have a double calendar, you're going to get two different bends like this. And as I've talked about before, we always get a bend at a strike. So we've got the 100-105 pairings. That's why we're getting a bend here at 100 and another bend here at 105. This is a double calendar. Well, then sometimes people say, well, gee, what's a double diagonal? It's so complicated because I do have two strikes here as well. Well, watch how simple it is. It's really the same thing, just with a slight twist. Let's go back to the pairings that we saw before. But now, just focus on the long positions down here. What would happen if we switched the call and the put? I'm going to keep the strikes the same, the 100 on the left, the 105 on the right. but we're just going to switch the call for the put and the put for the call. So watch this. We put the call over on the left, the put on the right. What happens now? Well, we still get exactly the same risk graph in blue, but take a look at the pairings now. I can look at the 100 call compared to the short 105 call. Now that's a diagonal spread. It's a long diagonal. And I could look at the long 105 put paired with the short 100 put. That's also a long diagonal spread. Now yes, in this case, because we have the 105 put, a higher strike on the right and the 100 call on the left, we have a box position built in here. We have a $5 box. And what does that mean? It means that this blue strangle right here must cost $5 more, or at least roughly $5 more, because interest rates aren't really all that big. But it's going to be roughly $5 more. So whatever the cost of the original strangle was in blue, this variation, putting the 105 put on the right and the 100 call on the left, is going to cost $5 more. And that's because we're guaranteed to get $5 back. I have the right to buy for 100 and I've got the right to sell for 105. Both of those are rights. We have the right to buy low and the right to sell high. That's $5. So it's a guaranteed $5 coming back. So it's really just that simple. If I just switch the call for the put for the call, and if we now put these two strategies together, guess what we get? We get exactly the same risk graph. Same maximum gain, same max loss, still get the bends at the same strikes. Everything is the same. Why? Because they're essentially the same strategy. How can that be? Well, also remember that calls are puts, puts are calls. Anything you can do with calls, you can do with puts and vice versa. So if you just keep those basic points in mind, you're going to find that the strategies really aren't all that complicated. It's more about understanding how to break them down into simpler components. And once you learn to do that, you'll be on your way to making better decisions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.